Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 11th day of December, 2018. Before I talk to you more about today's show, I do like to remind you, my newsletter is called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe by going to miningstocks.com. I'd like to encourage you also to consider subscribing to Chen Lin's excellent letter. Chen focuses to a great extent on the biotechs, also some energy and gold mining shares as well. ChenPicks.com is the place to go for that. And, of course, we also like to remind you to go to OliverMSA.com, OliverMSA.com, to sign up for either of Michael Oliver's excellent products. The one perhaps most directly related to the interest of the listeners of this show is his gold and silver report that he provides on a very frequent basis, a couple of times a week anyway. Some very interesting things that he'll be telling us in a minute or in a couple of minutes from now when we get a chance to say hello to him. Do want to thank our sponsors for today's show. They are RN Resources, Novo Resources, Sandstorm Gold, Triumph Gold, Gold Mining Inc., Uranium Energy, and Klondike Gold Corp. I've titled today's show, Where is America and its Markets Heading in 2019? David McElveny, Amir Adnani, and Michael Oliver are my guests this week. America's social and moral fiber is wearing thin, and the republic our founding fathers bequeathed to us in 1776 is rapidly being torn asunder. Why are traditional values being lost? Is it even possible to retain them in a rapidly changing world? How are declining moral values leading to America's economic decline? And given events within our control, what can we do to make this a better world, not just for ourselves materially, but also for the benefit of those we leave behind when we move on beyond the time and space of this world? So regarding the social and financial landscape of America, what does 2019 look like, and how should we prepare? Well, we're going to ask David McElveny to share some of his thoughts on those topics. One market that is coming to life is uranium. Not many people are paying attention to it, but the uranium market is showing real renewed signs of life, and I'm getting quite excited about Uranium Energy Corp. Amir Adnani will talk to us about the rapidly changing dynamics in the uranium market space. It look very exciting for this company, one of the premier rising companies in the United States at Uranium Energy, positioned to turn the lights on and start producing uranium as soon as the uranium price gets a bit higher than where it is now. And the prospects look very good for that stock in spite of the fact that it's near its lows, if not at its lows right now. And for a technical view on uranium and all the other key markets that we talk to him about every week, I'm really pleased to tell you that Michael Oliver is with me. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you with me, Michael. And wow, you put out a headline last week to your gold subscribers that actually had made the rounds in the internet. You said something like gold will take out 5-year highs in the next 50 trading days. In other words, sometime, I guess, within the next couple of months or so, you expect to see some real fireworks in gold. Do I have you right on that? And if so, what convinces you? You normally, Michael, don't talk in such unequivocal words, I would say. Usually, it's not that you're hedging, but you're just, your work tells you definitively or not, usually in one direction or not definitively, but this you seem to be very adamant that we are very likely to see some real fireworks in the gold space. Talk to us about that.
Yeah, I do, and it wasn't just examining the gold market via our metrics. It's examining everything. And we think the stock market is topped, and we think the stock market is on the verge within several percent of collapse mode. And obviously, you think about this. You're a wealthy person, whether you're Europe, Japan, or here, developed markets. You've got a lot of assets. If they were in the developed market stock indices, which they likely were, because why? They were performing well, right?
Sure.
All of a sudden now you're shaking. You're not quite so sure. The DAX index in Germany, the stout center of Europe is frankly just melting. We have frequent emotional rallies in the last month or so. The last 2-3 days go up 100 S&P points, etc. They hardly even flinch in their downside move. So the blue chips of Europe are in trouble. They've broken massive structures on momentum, trend structures that tell me not only is it the top end, but you're at risk of sharp collapse, a la 2987. But it's even worse than that because too many asset categories are also saying the same thing opposite. For instance, the T-bonds, which we got very bearish on in 2016, and again early this year at well above current levels, we flipped recently in the last several weeks and said, watch out, there's going to be one heck of a rally. And we think it's largely not because the economy is weakening or some kind of metric or like that. It's simply, I think, assets moving. And if you're moving out of stocks in the developed world, you don't want to go to the emerging markets yet because it doesn't feel good. You know, there's a feel-good sense there. And we think the emerging markets are a safer place to be, but they still don't net, on balance, feel good to most investors. Therefore, that's not an alternative. So what are you left with? Government bonds. But you got no yield in Japan. You got a 0.25% yield out of German 10-year bonds. 0.25%, okay? And meanwhile, our bonds, you know, yielding a couple percentage points, you know, well above those. Therefore, I think there's money moving into the bond market and the note market. And I think that's what's driving them. Why? Because I think they sense that something big is underfoot here. And not something incremental, but something large and huge drop in the stock market, for example. I think we've seen it before in history. The gold market is also feeling this. It's not volatile like the bonds are, but it's moving up through some structures on our momentum trend charts that tell us, okay, that August low we just saw at 1161, that was it. That was a secondary low, well above the 2015 low. You're not going to threaten that. And we flip back up now. We're 1250 area. We think that we've crossed enough hurdles to say with some confidence that this thing's going to likely move up through the highs of the last 45 years, which is to say the upper 1300s, meaning get to 1400 and you blow them all out. We think that could happen quickly. But there's also, aside from a technical reason for the speed, it's so obvious when you look at a price chart that the market's been up and down in that area each of the last 4 or 5 years into the upper 1300s. If you were to crawl your way back through there and break out, that is not the way it is likely to happen. Everybody would see it coming. Everybody would have time to reorient their thinking. And we've seen too many market turns of this variety that when you get this ripe and it's ready, it doesn't give you time to think, to have a committee meeting. Therefore, we think the next $100, $150 in gold could be very rapid. And we see that sense of speed in the bond market and in the stock market. So all the three combined tell us, yes, this time it's different. We go up, but we don't go up slowly.
All right, Michael, if we have that kind of a rapid rise then, would there be some dangers of a sharp pullback, or do you think that, you know, because... Between here and there, no. Especially, I'll give you another number. You get up into the 1280s. Now, that's just, 2.5% above this week's highs. And already gold's, like $90 off the August low. So I'm talking another $20-$30. You get up into the 1280s. Now, when you look at a price chart, that doesn't mean anything. It doesn't break out over anything. It's a teaser. Who cares? But on momentum, it says you're gone. That's where the breakout was above 1237, and we achieved that last week in the 1240s. That's where we are right now. But the next 2.5%, I think that's when you'll start to get the real volatility of upside movement, and not just $5-10 here, but all of a sudden whooshes of $20-$30 moves on the way up. So there's one more hurdle, but we didn't want to wait for that because we think what we crossed last week was significant enough, period. All right, so you're seeing it in the momentum charts. The price chartists aren't seeing it yet. You saw it when it got through 1237. And I might just tell my listeners that I see this all the time in your work, Michael, is that your momentum work usually gives a heads up before the people in the price charts see it in either direction. So this is one of the reasons that I really, really appreciate your work so much. Well, I'd like to ask you about uranium because our next guest, Amir Adnani, is the CEO of a up-and-coming company, Uranium Energy. He's going to be here to talk to us about that. What are your charts telling you about uranium right now?
Well, we started watching uranium. We also, in the energy sector, of course, was crude oil, which occupies everybody's mind and attention. And it did what we thought it would do in July and again in October, namely find resistance in the mid-70s. And so its recent pullback, which has been a collapse-type pullback, that's all the focus is on that. But what they're not noticing is the action of natural gas and uranium. Natural gas had a breakout for us in September. It went up 50% in the next 2 months. It never made a headline. 50% move in 2 months. Okay, uranium. It had been well over 100 back in the middle of the commodity boom in the 2008-10 period, and also there was a big drop into 2010 down to $40. But then it shot back up into the 70s. So these are price levels that uranium has been, but then it declined during the commodity decline of the last 5-6 years, all the way down to about $18, $17. That's like zero. I mean, it's not going to go to zero, but that's about as close to theoretical zero as a commodity of that former pricing could ever get. Well, it inched on up. There's a momentum base on uranium, annual momentum base, that goes back to, it got below its 3-year average back in 2011, and it had not been able to get above its 3-year average despite a couple efforts since then. So that's like a 7-8 year wide momentum base below the 3-year average. We registered a breakout, not above that level, but in the spring of this year above $23. Again, only about $6 off its low. That further generated a crossover of the 3-year average a month ago. 3-year average is $27.86. It's now about $29. So uranium, from our technical point of view, is now broken out of a massive momentum base. The only problem is, as far as vehicles go to participate in uranium, the uranium futures are highly illiquid. So you can scratch that off. You've got the uranium stocks, and your guest today, I think, is sitting in an optimal position in terms of, will he trigger reinitiation of production of uranium? I think highly likely, because the base has been completed. It's broken out. I think those prices you can wave goodbye to. We're going up.
All right. Well, it's certainly, just your trustworthy work, Michael. It's just so accurate over so many years now. I've been following you. Really want to thank you again for sharing your wisdom and your time with us. And as always, we look forward to talking to you next week again.
Thank you, Jay.